Everyone thinks money is about numbers and pure logic, but that's one of the biggest lies we've been sold. The real difference between staying broke and building real wealth has little to do with logic or math skills. It's shaped by hidden psychological traps that control how we spend, save, and invest. And here's the catch. Psychology is also the hardest part to measure, explain, or control. That's what Morgan Housel dives into in The Psychology of Money. And in this video, we're going to expose the most dangerous money myths that keep people stuck and show you how to break free before they steal years of your financial freedom. Money Myth 1. Money is pure logic. As I just mentioned, we often think money is just numbers. Add this, subtract that, and the answer should be the same for everyone. But here's the puzzle. Two people can look at the exact same stock chart. One decides to buy, the other decides to sell, and both are completely convinced they'll make a profit. How does that make sense? Because they're playing different games. Every investor brings a different past, a different risk tolerance, and different goals to the table. Think about it. A person who lived through the Great Depression often carried fear of markets for the rest of their life, no matter how much they recovered later. On the other hand, a tech worker riding the boom of the 1990 seconds might see risk-taking as normal, even smart. And today, many Gen Z investors see crypto's wild swings as just another Tuesday. 50% up or down feels like part of the game. In other words, each group is living in a different mental economy, even though they share the same financial world. I once saw this play out between two colleagues who received the same $5,000 bonus. One of them put it straight into an emergency fund because every late bill in their past carried stress they never wanted to relive. The other used it as a car down payment because for them, nothing felt worse than looking poor after years of scrimping. Both thought they were being smart. Neither was crazy. Which means, don't rely solely on your own past experiences or chase some perfect one-size-fits-all system. Instead, broaden your perspective. Study economic history from different eras. Learn from investors older or younger than you, from different cultures and backgrounds. And most critically, define your game. Are you investing for retirement, for financial independence, or for speculation? Once you know that, it becomes easier to tune out the noise, especially the advice that was never meant for your game in the first place. Money Myth 2. We can control everything. One of the most seductive myths in personal finance is the belief that outcomes are fully within our control. That if we just follow the right steps, work hard enough, and copy the formula of someone successful, we'll get the same result. As if success were a recipe you could bake the same way every time. But money doesn't work that way. Author Morgan Housel points out that behind every success story, and every failure too, are two invisible forces that shape the outcome far more than we like to admit: luck and risk. To illustrate this, he shares the story of Bill Gates. Bill Gates is a genius, no doubt. He built Microsoft into one of the most valuable companies in the world. But what's often overlooked is a crucial detail, a rare, life-shaping twist of fate. As a teenager, Gates went to one of the very few high schools in the United States with a computer. That stroke of timing was 1 in a million. It gave him years of practice most kids never had. Now, compare him to his close friend Kent Evans. Equally brilliant, equally obsessed with computers, equally ambitious, but Kent died in a mountaineering accident before finishing high school. What are the odds? 1 in a million students had access to a school computer. 1 in a million students die in a mountaineering accident. One got a head start, the other never made it to the starting line. That is the luck and risk I was talking about. So what's the lesson? Don't just read stories about the most successful people and admire the rare, magical moments. Instead, try to spot the common patterns across many smaller success stories, things like saving consistently, managing risk, and leaving room for error. Because, at the end of the day, you can't control luck, and you can't completely avoid risk. What you can do is make smart decisions, put yourself in the best possible position, and be ready for whatever life throws your way. Money Myth 3. Stories don't lie. Why do people keep falling for get-rich-quick schemes? As Morgan Housel notes in his book, it's because most of us are moved more by stories than by statistics. The crypto boom of 2021 was one of the clearest examples of how stories drive money. Everywhere you looked, someone was telling a money-making story. Your neighbor, TikTok influencers flashing sports cars, even the Uber driver with the next hot coin tip. Thousands of new tokens launched almost overnight, most of them with no real product, no business model, not even a roadmap. But they all carried the same irresistible story. Get in early, don't miss the chance to buy the next Bitcoin. And people jumped in. For a while, the story worked. Prices shot up, and it felt like the rules of money had changed forever. But by 2022, the air came out of the balloon. Projects disappeared, coins collapsed, and billions in wealth evaporated almost overnight. Or consider a more familiar case, winning the lottery. One winner out of 300 million becomes an overnight celebrity, sharing their miraculous victory, while the millions who lost fade into silence because no one thinks their stories are worth telling. And what sticks in our minds isn't the near impossible odds, it's the fantasy of being that one lucky person. This is why stories are dangerous in money. They highlight rare wins and hide the countless failures. They turn randomness into something that looks like a plan. But don't mistake a narrative for a roadmap. Rare wins are not repeatable formulas. Real wealth comes from boring, consistent, data-backed decisions, not from chasing the next great story. Money Myth 4. The perfect plan exists. There's a line in the book that says, "The most important part of every plan is planning on your plan not going according to plan. We plan because we want control. We want certainty. But history keeps teaching us the same lesson. Reality does not bend to our perfect plan. The biggest events that shape markets and personal wealth are almost always the ones nobody predicts, like the oil shocks of the 1970 seconds, the 2008 financial crisis, or the sudden arrival of COVID-19. And if you look ahead today, AI disruption, geopolitical risks, climate shocks, we know that surprises are coming. We just don't know which ones or when. That's the nature of uncertainty. And it's not just the outside world that changes. We do too. We're quick to notice how much we've changed compared to 10 years ago. Yet we assume the person we are today is fixed. But fast forward another decade and we'll almost certainly look back with the same surprise. A 25-year-old might want to travel the world and explore, only to change their mind and long for stability at 40. Another might embrace extreme frugality early in life, then regret the lost experiences years later. This is why the idea of a perfect plan is so misleading. The smarter approach is not to chase perfect optimization, but to build resilience. To understand this better, consider the difference between being rational and being reasonable. Rational might say, put every dollar into equities for maximum return. Reasonable says, keep some cash aside so I don't panic and sell when the market drops. Rational looks great in theory, but reasonable is what actually survives in practice. So the lesson is clear. There is no perfect plan. There are only plans that are fragile and plans that are resilient. And in a world full of uncertainty, resilience wins every time. More specifically, we can. Build room for error with emergency funds. Diversify so that no single risk can sink you. And treat your plan as a living document that evolves with you. Money Myth 5. Success is a perfect streak. We tend to assume that the most successful investors or entrepreneurs are the ones who consistently make brilliant decisions. But reality tells a different story. Warren Buffett's widely considered one of the greatest investors of all time. Over his lifetime, he has made more than 400 investments, and yet nearly 90% of his wealth comes from just 10 of them. Art collecting tells the same story. Heinz Berggruen, a celebrated collector, bought thousands of works of art over his lifetime. Most of those pieces never made him famous, never defined his reputation. But a few masterpieces from artists like Picasso and Matisse did. This is what statisticians call tail events, the small minority of outcomes that produce the vast majority of results. Success, in both cases, is rarely a smooth line upward. It's uneven, messy, and full of dead ends. And yet, we often see ourselves as failures whenever an investment flops or a startup stalls. But if we understand how success really works, we'll realize those setbacks aren't proof we're doing it wrong. They're the cost of admission to the chance at a tail event. So, here's the mindset shift. Don't measure yourself by whether every step is perfect. Measure yourself by whether you're still standing when the rare opportunity comes. Money Myth 6. More is always better. The myth here is simple. We assume that more money, more possessions, more luxury will always bring more happiness, more respect, and more security. But in practice, chasing more often destroys what we already have. History is full of reminders of how dangerous the pursuit of more can be when there is no finish line. Sam Bankman-Fried, the founder of FTX, was worth around $20 billion at just 29 years old. That's more than enough to secure several lifetimes of comfort. But he kept pushing for more, quietly misusing customer funds, and in the end, the entire empire collapsed almost overnight. That's why the author points out a few key lessons. The hardest financial skill is to make the goal stop drifting away. Because every time we get closer to our goal, the goal moves. We make more money, then we want double. We buy a nice home, then we dream of a bigger one. If our expectations grow just as fast as our results, we'll always feel like we're falling short, even when we're doing well. There are many things in life that are simply not worth risking, no matter how big the potential gain. Things like reputation, freedom, the people we care about, our peace of mind, the love and respect of those closest to us. Once these are damaged, they're incredibly hard to earn back and in some cases impossible. And our best chance at protecting them lies in knowing when to stop when we've hit enough. Money Myth 7. Looking rich means being rich. We live in a world where showing off is almost a sport. The luxury watch, the weekend trip, the perfect car. And it tricks us into believing that looking successful is the same thing as being successful. But Morgan Housel doesn't sugarcoat it. In his book, he shares one of the most brutal truths you'll ever hear about money. Spending money to show people how much money you have is the fastest way to have less money. And honestly, that feels painfully true. Market data shows that even high-income earners, people making 6 figures or more, often live paycheck to paycheck because expenses expand to match income. It's called lifestyle inflation, and it tricks you into thinking wealth grows with spending, but that's not how real wealth works. In fact, the people who are actually rich, the ones with lasting financial security, are often the least flashy, because they're not spending to show it off. Why? Because they've learned a simple truth. Looking rich is about spending. Being rich is about not spending. True wealth isn't the sports car in the driveway or the expensive dinner bill you post online. It's the money sitting in their savings, the investments they don't touch, the freedom to make choices without fear, and the peace of mind that comes from knowing your future is secure. Money myth 8. Caution is wise. Optimism is naive. If you've ever noticed how quickly people perk up at bad news, you'll know why pessimism has such credibility in money. Say the market will crash, and everyone listens. Say it will rise steadily for the next 20 years, and they yawn. That's because pessimism feels smart. It sounds like protection. But the truth is, history shows us that optimism, not pessimism, is what delivers progress. Take the dot-com crash of the early 2000s. Back then, the headlines were everywhere. Tech was dead, the bubble had burst, and the whole sector looked finished. And if you had listened to the pessimists, you might have pulled out of the market completely. But look at where we are now. 2 decades later, technology companies like Amazon, Apple, Microsoft, and Google don't just exist, they dominate the global economy. What felt like the end of an era was really the messy beginning of one. Now, optimism doesn't mean blind faith. It doesn't mean ignoring risks or pretending nothing can go wrong. Real optimism is more practical than it sounds. It's about seeing short-term setbacks for what they are, temporary bumps, not permanent roadblocks, and refusing to let every market drop or scary headline push you into panic mode. Real optimism means trusting that solutions will be found, that innovation keeps moving forward, and staying invested long enough for compounding to quietly work in your favor. Because when you zoom out, history shows that even after wars, recessions, and crises, the long-term trend has always been up, and there's no reason to think that trend has suddenly stopped. Money myth 9. Money is the ultimate goal. A lot of people believe that the whole point of working, saving, and investing is to reach one finish line, getting rich. But Warren Buffett has a way of reminding us that money itself is never the real prize. In his biography, The Snowball, he said, "I can buy anything I want, basically, but I can't buy time." As the book explains, the ability to do what you want, when you want, with who you want, for as long as you want, is priceless. It is the highest dividend money pays. In other words, true wealth is not about what you own, it's about what you no longer need to chase. It's about freedom from dependence, not the accumulation of luxuries. So here's the shift to make. Wealth isn't measured by money or possessions, but by independence. And financial freedom isn't just about retiring early, it's about having control over your time. Money myth 10. There is such a thing as free. We like to think that if we've picked the right investment, it should feel safe and steady, like we can just sit back and watch our money grow. But that's actually the myth. Even the best investments will test our nerves before they reward us. Because everything has a price, and the key to a lot of things with money is just figuring out what that price is and being willing to pay it. Take Netflix, for example. From 2002 to 2018, the company returned more than 35%. But during that same stretch, Netflix spent 94% of the time trading below its previous high. In other words, to enjoy that life-changing return, you had to endure when the stock plunged, headlines screamed disaster, and fear that maybe this was the end. That was the fee you had to pay. The problem is, most people can't handle that price. Our brains are wired to run from pain. So when markets drop and fear spikes, we treat it like a sign we did something wrong. We panic, we sell, and we lock in our losses, missing out on the very rewards we were chasing in the first place. But once you accept that market volatility is a fee, once you see it as the cost of playing in the neighborhood of wealth, you stop panicking every time markets stumble. Money myth 11. Wealth is about making money. It's true, If you want to build wealth, you need to know how to make money. That could mean taking calculated risks, or catching the right stock at the right time and watching the numbers rise and fall in your account. But here's the part most people never prepare for. Making money is just the beginning. Keeping it is just as hard, maybe harder, and it requires a completely different mindset. The very traits that get you rich can be the ones that wipe you out if you don't learn to switch gears. To get rich, you need boldness. To stay rich, you need humility. To get rich, you need optimism. To stay rich, you need a healthy dose of paranoia. Ike Batista was once the poster child for Brazil's economic boom. He built his fortune from scratch in his 20s, creating a business empire that spanned mining, oil, shipbuilding, logistics, and construction. But instead of slowing down to protect what he had built, he kept borrowing, kept doubling down, and kept chasing the next big win. When oil prices crashed and a few of his companies failed to deliver, everything unraveled in a chain reaction. So the lesson here is straightforward. Making money is a sprint, but staying wealthy is a marathon. The winners in this game aren't the ones who run the fastest, they're the ones still running when everyone else has dropped out. Money Myth 12. Small money doesn't matter. When people think about building wealth, they often imagine extraordinary strategies like finding the next Tesla, timing the market perfectly, or making one bold move that changes everything. But the truth is far less glamorous. Real wealth doesn't come from brilliance, it comes from time. And no one proves this better than Warren Buffett. Buffett is worth over $160 billion today. What most people don't realize is that more than $150 billion of that came after he turned 65. If Buffett had retired in his 60 seconds, he'd still be successful. But the world probably wouldn't know his name. This is where our brains play tricks on us. We tend to think in straight lines. Put in more, get out more. Growth feels like it should be steady over time. But compounding doesn't work that way. It's exponential. At first, it looks boring, almost invisible, like nothing is happening. For example, $1 invested at 10% only grows 17 times in 30 years, but if you give it for 50 years, it grows 117 times. And here's the first rule of compounding: don't interrupt it. It doesn't matter how good your return is if you can't stick with it through downturns or if you pull the plug too early. And now that we've explored all these myths together, you can probably see how they fit like puzzle pieces rather than standalone lessons. Each one supports the next, shaping a solid foundation for how we think about money. It starts with understanding the game you're really playing, your goals, your timeline, your priorities. From there, you decide what enough means for you, which frees you from the endless pressure to chase more. When markets swing or setbacks arrive, you're able to see that discomfort as the price you pay to stay invested instead of a signal to give up. And when you give yourself time, real time, measured in decades, not days, that's when compounding works its quiet magic, turning steady, ordinary decisions into something extraordinary. And of course, once your finances are steady, it's just as important to strike a balance between building wealth and protecting it, because that's how you create a foundation that lasts. All of these lessons, when you put them together, aren't just about money, they're about how to build a life that's stable, intentional, and peaceful. And if this video helped shift the way you think about money, go ahead and hit like and subscribe. We've got plenty more content like this waiting for you. Thank you for being here.